Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about INT'L International Holdings Limited annual report. INT'L International Holdings Limited offers a diverse range of businesses and services. At its core, the company engages in property development and investment, with a portfolio that includes residential developments, office towers, hotels, serviced apartments, and retail premises. In addition to property development, INT'L also provides property management services for various types of properties such as residential buildings, commercial facilities, office towers, and real estate complexes. This comprehensive service ensures the smooth operation and maintenance of these properties. Furthermore, the company offers financial, management, and decoration services, catering to a wide range of needs from its clients. With its extensive experience in property development and investment, INT'L International Holdings Limited has established itself as a reputable player in the industry. INT'L International Holdings Limited maintains a market capitalization of $7 billion, broadly in line with the industry peer group. INT'L International Holdings Limited trades at a lower price-to-book ratio of 0.18 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 37% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a review of the key factors that have impacted the company's revenue over time. Revenue growth is primarily driven by several key factors. Firstly, attributable contracted sales have been a significant contributor to revenue growth, with $5.7 billion in contracted sales for the year ended 31 December 2025. Additionally, joint ventures and associated companies have also contributed to revenue growth, with an increase of $1.785 billion in 2025 compared to 2024. Furthermore, property development revenue in Hong Kong has seen a significant increase, with $155,410 in additional revenue. Rental income from property investment has also increased, with $598,414 in additional revenue. Other factors that have contributed to revenue growth include the pre-sales of units in Avenir and the handover of pre-sold units to buyers in 2026. The sales of remaining tower in Sierra and leasing activities commenced in VETTA have also generated significant revenue. Moreover, the stabilization of the mainland property market and supportive measures such as down payment reductions and competitive mortgage rates have also contributed to revenue growth. On the other hand, revenue decline is primarily driven by several key factors. Firstly, attributable contracted sales in the mainland have decreased by $743,717. Additionally, revenue decline in Hong Kong has been significant, with a 47% decrease of $298,490. Furthermore, interest income from banks and net gains on settlement of derivative financial instruments have also decreased, with $57,413 and $57,415 respectively. In conclusion, the primary drivers of revenue growth or decline can be attributed to various factors such as attributable contracted sales, joint ventures and associated companies, property development revenue in Hong Kong, rental income from property investment, pre-sales of units in Avenir, handover of pre-sold units to buyers in 2026, sales of remaining tower in Sierra, leasing activities commenced in VETTA, stabilization of the mainland property market, and supportive measures. The company's net income saw a significant decline, plummeting by $501,205, resulting in a loss of $162,931. This downturn can be attributed to various factors affecting the company's profitability. A closer look at the profit margins reveals that while the gross profit margin increased from 18.9% to 0.2%, it is not enough to offset the decline in operating profit margin. The latter decreased dramatically from 9.8% to a loss of 28.6%. This sharp drop in operating profit margin suggests that the company's operational costs have exceeded its revenue, leading to a substantial decrease in profitability. The company's debt level has undergone significant changes in the recent period. A decrease in non-current liabilities by $423,179 and total borrowings by $125 million indicates a reduction in the company's financial obligations. Furthermore, available undrawn banking facilities have also decreased from $17,666 million to $15,878 million. However, despite these changes in debt levels, interest expenses have not seen a significant decrease. The average interest rate has actually decreased to 3.1%, down from 4.3% in the previous year. This suggests that while the company's debt burden may be decreasing, it is still incurring substantial interest expenses due to its existing borrowings. The company has a history of paying out dividends to its shareholders. This is evident in various sections of the report, where it is explicitly stated that the company has paid dividends. On page 1, it is noted that the dividend policy for the year is yes, indicating a commitment to distributing profits to investors. Furthermore, on pages 10 and 24, specific details are provided regarding interim and final cash dividends, as well as the payment of these dividends. Additionally, on page 18, it is mentioned that the company received $195 million in dividends from GEG, which further supports the conclusion that the company has a dividend-paying history. Overall, this suggests that the company prioritizes returning value to its shareholders through dividend payments. That concludes the financial summary for KWA International Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.